this sort of turmoil in the IPO market, does it hurt the broader listed companies or not?
Well, no, I don't think it does hurt the broader listed companies, but I think it's a reflection of what's going on in the market right now, which is, in general, big risk aversion. The defensive this last month have continued to outperform, but we saw the big momentum names down a lot, of which I own a bunch, but they're down anywhere from 15 to 20%, similar to last December. The question is, will they come back in? But I think there's a real bifurcation. You know, if you see 120 IPOs have happened this year, half are below their listing price. And I think that it's really companies with revenues that have solid outlooks. Those are the ones performing, and those that aren't are the ones that are getting killed. And I think the responsibility there lies with the bankers, you know, who really have to be advising these people. Because I do want to mention Facebook. If you remember, back in 2012 in May, they priced at 38. Stock went up to 45. I opened at 42, went up to 45, but closed just a tad over 38. Within the next few months, it was cut in half, and it took almost 15 months to get back to that price. And then, of course, we know what's happening. So in terms of the worthiness of some of these businesses, I'm not sure being below your offering price means all that much, but I think it does reflect the general mood of the market, and I think the bankers have to do a much better job of really pushing back on managements who want to get the maximum dollar.
Yeah, that's a good point. Stocks down about 167 points for the Dow with 50 minutes left in the trading session. For more, let's bring in Patrick Palfrey, Senior Equity Strategist at Credit Suisse. And Patrick, you don't really believe in this rotation continuing out of growth and into value. Tell us why.
Well, if you take a step back, investors are investing in an environment. And over the last 12 to 18 months, what we've seen is interest rates on the 10-year go from roughly 3.25 to bottoming somewhere around 1.4. In that environment, what is going on? Investors are looking for safety and security because the economy is perceived to be slowing, and they're looking for growth, and where can they find that? And that's really the reason why we saw low volatility and growth stocks outperform. What happened in the beginning of September, we saw a potential thawing in the Chinese trade relations, as well as some other positive macro factors. Interest rates popped on that, so investors said, maybe this trade is over, I need to unwind it. In reality, the backdrop is not getting any better. We expect interest rates are down from here. That growth trade, that low vol trade, that no value, that is going to be the trade that's going to work going forward.
So the kind of communication services, tech sectors, which are the bottom of the pile today, you use as a buying opportunity?
Yes, absolutely. And in reality, what we don't want is we don't want economic cyclicality in our portfolios in this falling interest rate environment. GDP is slowing. We don't want to own industrials. We don't want to own materials. Interest rates are falling. We don't want to own financials. In that environment, where do we gravitate towards? Companies with growth, technology, communications. They're places where investors want to be because the growth is going to be there, and they've shown it time and time again.
Yeah, Barb, if you look at some of the winners so far in the month of September, small caps are up about 5%. Beaten down energy names are down around 5 to 6%. Are these the type of sectors you want to own towards the end of the year?
I don't think so. The small cap, I think, is really just a bounce, off of really low levels, because the small cap names are the ones that are really getting hurt, whether it's China issues or slowing growth, but they're the ones who are seeing real pressure from their margins. In energy, energy is so dependent on supply-demand dynamics, which seem to weekly change, depending on various, geopolitical factors. So, I think the Exxons of the world, anytime those come down, yes, you can buy the big integrateds and be fairly, safe in terms of that. But in general, I would stay away from those sectors.
Patrick, earnings season, do you think that has the power to disappoint, surprise on the upside?
I think we're looking at a backdrop for growth that is roughly flat on an earnings basis, and that's likely where we're going to come in. It's not inspiring. And investors are going to say, what is going on? There's a few interesting things happening. We have issues within tech margins, and we have issues within the oil space. But what's important, though, is if you take a look at the typical company in the S&P 500, which is what most people own, the growth rates look much better for that typical company, and that's important. And that's really the reason why we're not seeing the market sell off, despite the fact that we have this anemic earnings growth backdrop.
Where do you stand, Patrick, on the banks at the moment?
Right now with banks, it's difficult to get inspired with an inverted yield curve and the long end that's falling. It's just a backdrop that makes it very difficult for them to profitably lend.